depending on our cost basis and equity in the deal, right? Sometimes it recently just made sense where we're like, you know what, like we just have too much equity sitting in here trapped. Like we just got to unload this thing, right? And you can talk about sitting on buildings, and even if it's locations that you like, right? The issue is if you got $500,000, $1 million of trapped equity, I mean, it's just dead money for you, right? And it's hard to use that to scale.
Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate sponsors and syndication experts from every corner of the United States. We teach you how to harness the power of passive real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
What's up, guys? Welcome to episode 130 of the Creating Wealth Podcast. I am your host, Kyle Curtin. I am a co-GP specializing in investor relations for multifamily sponsors. Today, we get the great pleasure of chatting with Lior Rozhansky. Lior is a phenomenal Boston-based investor, managing member of Flora Capital, rockstar real estate agent. The list goes on. Super excited to have you on here again, man. What's going on, Lior? How are you?
Not much, man. Glad to be back here. We were just chatting it up that this is a 3-year anniversary since we last did an episode. So, like, man, it's a 3-year run back. So I guess we should have enough to chat about.
Yeah, we get some time. Yeah.
Yeah, man.
Yeah. Guys, to Lior's point, like we were just chopping it up about that a minute ago. And it's funny that he brought it up like before we started recording, because I looked back to when that actual like date was and the episode number. Lior was the 4th person to come on the podcast in 2020. So absolutely, extremely excited to have him on here again and kind of catch up from the past 3 years of everything,
Yeah.
But yeah, man. So I'm excited. Like I'm trying to think of like a phenomenal way to kind of start off, man. I mean, I guess take us through kind of like a brief way from where the focus was maybe when you first came on the show, to maybe kind of like how things have kind of shifted, going a lot heavier in the investment side, like the private equity, side that you have going on, and the floor is yours. Any way you want to go is cool.
Yeah, for sure. Yeah. So, I would say in terms of shift, when I was first starting out, so I was buying my first buildings in 2017, have always been in the Boston area. Well, radius has always been within 15, 20 minutes of the city. That's just, that's the markets I believe in, even though they're tough to play in. We started by buying smaller multis that we would, really strictly only do buy and holds. And that was kind of the philosophy, which is great, right? I mean, we built up a really very healthy portfolio of city multifamily. But one of the things that we kind of adjusted, and I've kind of adjusted myself in between all my different little avenues, is just become a lot more understanding in how to manage a portfolio, right? And it's not only just about buy and holds, because it certainly works. The issue is, for anyone that's scaling out and doing a ton of buy and hold projects at once, you're going to get into a liquidity, you get into liquidity crunches. It's hard, right? I mean, it really is hard, especially when you're doing a lot of projects. So kind of shifted in the sense that we're, doing a lot more. I mean, we're still doing very apartment focused. Will always be the core of our focus, but have been a lot more transactional, right? We've sold more buildings, that some that we've renovated, some that honestly we just bought at good cost basis and just unloaded. And part of it is, of course, investor returns and kind of return capital sooner. The other part of it is just kind of strategically managing our workload, right? It's just figuring out, again, which are the buildings that we want to sit on long term? What are the buildings that we're okay giving up? And kind of just being a little, much more transactional and much more actively managing, our own portfolio.
Yeah, no, I love it, man. And one of the things that just kind of popped into my head as you were mentioning that is I wanted to ask you, like, what's your perspective on like trimming the fat when you pick up a portfolio and kind of like going through that dynamic of like, all right, like these ones are, pretty much just a pain in the ass. Like, it might be better off offloading those ones, in terms of like just thinking about like time and returns and that type of thing. And which ones do you kind of focus on like holding on to in a sense? And I know it's a pretty loaded question, you know what I mean? But
yeah, no, it's a fair question. I mean, the probably number one filter, of course, is probably a financial filter, right? So depending on our cost basis and equity in the deal, right? Sometimes it recently just made sense where we're like, you know what, like we just have too much equity sitting in here trapped. Like we just got to unload this thing, right? And you can talk about sitting on buildings, and even if it's locations that you like, right? The issue is if you got $500,000, $1 million of trapped equity, I mean, it's just dead money for you, right? And it's hard to use that to scale. I'll give you a good example, right? We're doing one of my it's still probably one of my smaller projects, but we picked up two kind of large two developments, right? One was a 6-unit gut rehab of a previous commercial building that we're turning into an apartments now, and then one is a 3-unit new construction ground up, right? That we when we bought it in 20 or 21, first we were like, oh, we're gonna keep both as rentals because they're going to be great and we love the location. But when we kind of thought about it with our, especially the cost basis on the 3-unit ground up, you start kind of do the math and you're like, well, yeah, I mean, we could definitely sit on it, but we'd legit have probably, like I said, 800-900, maybe $1 million of trapped equity in there. Just doesn't make sense, right? So, instead of being fearful of selling, and a lot of it is, I will admit, a lot of it in the past has been kind of fear mentality, right? Like, what if I can't refill the portfolio? What if I can't find another deal like that? Right? And that's something that you kind of grow out of as you do more deals and you get really good, really confident and transactional. But yeah, so on that particular example, we decided, we're going to sell off those 3 units as condos. Definitely not my bread and butter strategy by any means, but it's there, it's an exit, and then we'll keep the 6 units as an apartment play. And we kind of have the best of both worlds, right? We still have a good asset that we like that's fully gutted, while we have some liquidity freed up to go do more and bigger, better projects. Yeah.
No, I totally get where you're coming from, man. And it's funny that you say that about like the trapped equity, because that's a question that that kind of came to mind yesterday. Because even like obviously on a much, much smaller scale for where I'm at, like myself currently, my building in Leominster's got like 170K in equity in there, and I'm like shit, man, like, my rate luckily is like sub 3% and everything and whatever. And cash flow is okay and that type of deal. But I'm like, I was only able to leverage a home equity line, which has a pretty great, double-digit interest rate now. Yeah. But now I'm like, damn, man, you know what I mean? I'm like, what if I, made some crazy play and then, had a good amount of capital to play with, and it's the questions that kind of start coming to mind of like, how do you keep the velocity flowing? And it's like, does it make sense to hold it for a bit more, do some sort of like 1031 and like JV but yeah.
Yeah, no, look, I mean, listen, trapped equity. I mean, we all have it. The extent of it is, and the amount that you're comfortable with it is very much dependent on your pipeline and how much projects you have. I mean, like, for me and me in particular, I mean, I was just doing a list on my board and behind me, like, I mean, I've got a ton of open sites right now, right? Like, and a lot of them have overages, right? I mean, it's the city and shit happens, right? So instead of scrambling every time, I mean, we've never done a capital call, additional capital calls, and I don't plan on ever doing it. But, if I'm planning on opening another, going from like 10 active sites to like 15 or 20, I mean, that's going to be even more free cash that I need to, use, right? Or if there's a deal that I need to tie up, that's capital that can be worked for you, right? I mean, it's funny. The very first property I bought, I still own today. It was a 3-family in Everett in 2016. I mean, when I first bought it, yeah, it was the same thing. I had a rate of like maybe 4% or something like that. And I've relevered that thing like 3 times at this point. And I mean, my debt today is, I think it's like 6 or 6.25. But, here's the thing, man, is like, your rates on stuff, especially if it's like 30-year fixed debt. Yeah, I mean, you're going to lose out on cash flow and whatever. I mean, it's $1,000 or even if it's like $1,500 a month, right? I mean, a lot of people will be like, holy shit, man, like $1,500, $2,000 a month. That's a lot of cash flow. But I don't really see it that way, right? Like if I can free up $150 of cash today, man, I'll give up that $1,500 without even thinking about it. Like, send me the paperwork, right? Like it's not even a question, because the issue is, again, a lot of this depends where you're at, right? But like, us guys, we're younger. Obviously, we're looking to scale out. That $1,500, $2,000 a month is not going to do anything for me, man. Like, it'll get me another burger if I want it, and that's about it, right? Like, how far does it go in Boston? So yeah, for me, it's always been more about what are the plays I need to make it advantageous for me to be able to scale out. Yield and cash flow, very, very much secondary afterthoughts, honestly.
Yeah. Yeah, no, I think it makes a ton of sense, man. And like even the thought of that, of constantly, not constantly, but strategically, trading different assets and that type of thing. It became clear to me because I was listening to Axel Ragnarsson's podcast. And like that was kind of where I first like kind of heard some of those thoughts of like, oh, many people out there are like, oh, just like hold it forever, or like, whatever, like keep like re-leveraging the shit out of it, for years and years and years. But then it's like, well, eventually, like now what are you going to do? Like, you know what I mean? You're constrained, and it's like, sometimes you got to sell to keep buying and keep playing the game. And it was an interesting thought.
Yeah. I mean, I remember Axel had a good pod about it where I remember he was talking about this where he was, I mean, his thesis was more along like, like if you don't free up transaction, like how are you going to scale out, systems, people, all that. And that's absolutely fair too, right? I mean, if I've got people that I pay as well now. And, it's not fun to be able to scramble for cash every time I make that payment, right? That's no one wants to do that. So yeah, man, I mean, at the end of the day, a lot of it becomes, I think, where you're at, right? I mean, look, if I'm like, in the later half of my life and I'm just like trying to chill, yeah, man, I'll sit on my building and I'll make decisions very differently. But, like I said, I mean, if I'm trying to scale out both on volume wise, people wise, all that, I mean, you need free capital, right? At the end of the day. So, and again, that $1,500 a month that, you've been dreaming about since the day you've read about Biggerpockets, I mean, it ain't going to do much for you, right? That's just kind of the reality. So,
yeah. I think it's a very interesting conversation, man, especially in the market now. You know what I mean?
Especially in the market today, man, because I mean, now, I mean, I'd say probably the last month or two is really when our phone's been starting to blow up with like a lot of product or land deals that just are not moving. So now is really the time where you really do want free capital, right? Because, if you're going to be, I mean, there's some stuff I've been seeing that I'm like, wow, like I can't believe we're buying it at these, we can even think about it at these prices. I mean, just last year it would have been 25% higher, right? So yeah, I mean, on the acquisition side, I mean, you absolutely need free capital. It's, it's key again if you're trying to scale. So
yeah, 100%, man. So to kind of segue into like, talking about some of the development stuff, is that, I know that's obviously a huge focus of you guys, and I'm very excited. I saw the picture that you guys put up yesterday of that like 3-story, three. Yeah. That's kick-ass, man. I love it. So
thank you.
How did that kind of like, or I guess kind of take us through, that model right now? Like, are you looking more for kind of like buildable land, or kind of like misused, like not highest and best used sites to kind of like, convert to be able to build, better on it? Or what's kind of your thoughts?
Yeah, I mean, again, I don't consider myself a developer versus like strictly investor or something like that, right?
Yep.
At the end of the day, I'm kind of just opportunist, right? Like wherever I see the opportunity and wherever I feel like, there's a play to be made, that's what we'll look at.
Yeah.
I mean, there's been, it just happens to be the case that there's been several land deals that have kind of really made a lot of sense. So we're going to approach them, right? I'm going to approach them pretty aggressively. I mean, that one you just mentioned, I mean, honestly, it was kind of a misuse lot, right? I mean, we picked it up as a package with another building, and that the owner had no sense of value on. It's one of the best neighborhoods in Dorchester, and we basically picked it up for like literally almost nothing. And now we're building out a $2.3 million back end project, right? I mean, that's the stuff you kind of look for in terms of opportunity, right? So yeah, I mean, I would say we're looking at everything. I mean, I would say existing product is still definitely a focus, no question about it. Still very much active on that. I mean, we've been buying smaller buildings, larger buildings, and just kind of executing, typical value add stuff. I mean, from kind of medium stuff, kitchen and bath stuff, to heavier guts, still banging those out. But I do see, I mean, I honestly, I do see more and more plays potentially coming out on the land side, because there's just not a lot of developers now. I mean, most developers are kind of sitting on the sidelines, and I mean, yeah, it's much tougher to get financing. I mean, on the equity side, on the debt side, I mean, it's very, very, it's definitely significantly tougher. But I mean, it's possible. I mean, I helped someone finance a single family that we're doing ground up in one of the wealthiest suburbs here. Bank came in hungry, right? I mean, it was just a relationship I had. If the numbers make sense, you provide enough spread, I mean, they'll do it, right? So the opportunity, I think, is, like I said, it's there. Whether it's in ground up or with existing product, I mean, wherever the opportunity is, that's where we'll be. So.
Yeah, no, I definitely hear you, man. Yeah, I think it's awesome. So for some of the folks that might not be as familiar with Boston and kind of like the I guess like the ABCD like scale, if you will, take us kind of through maybe like what's unique about like some of those areas in Boston versus maybe like other parts like 15-20 minutes away from the city. And I guess kind of like, even like myself, I'm not in the city too much, you know what I mean? The last time I was there was probably with you, actually.
Yeah.
To be honest. But yeah, man, like, I guess kind of like navigating, I don't know, like, or I should say, let me rephrase my question in a different, set of words, I guess. Do you, I guess, depending on the particular like area within the city, like neighborhood, that kind of thing, do they differ a good amount from each other in terms of like, A class, B class, like the strategy? I don't know. Yeah.
Yeah. I mean, very, very much so. I mean, I think if you're operating in any major metropolitan, I mean, whether it's New York, Boston, Miami, right? I know it's very popular too. I mean, it's very, very much neighborhood by neighborhood, right? I mean, even, I mean, it's even from like neighborhoods within Boston, honestly, some neighborhoods it's street by street, right? I mean, street by street, like there's some streets that are like gold mines and you're going to crush, and some other, you better watch out, right?
Yeah.
So yeah, you really got to know your stuff. I mean, look, I mean, at the end of the day, the thesis of why I'm in Boston and will continue to be, most likely that will continue to be my at least primary market, is I believe in it, right? I mean, it's an expensive market. So first of all, it's a high barrier to entry. Not a lot of guys can take down units at $300-$400 a door, right? I mean, most guys just can't really can't pull that equity, can't really put those deals together. And it's tough, right? I mean, it's not an easy game to play. I think there's also a resiliency factor to it, right? I mean, obviously right now markets all around the country have taken beatings, right? And, particularly markets that were, the hot markets and COVID and everything that every kind of new, GP was trying to sell his soul on. They're taking beatings, right? I mean, they're taking absolute beatings right now. The Phoenixes of the world, the Austins of the world, the Carolinas of the world. Not to say that one market's better than the other, but again, the reason why I like the reason why we operate so heavily in here is it's resilient, right? It's much less open to that volatility, right? I mean, we're not going to have those crazy curves up, but I'm also not going to have those crazy curves down. So it does give you a little bit more of a better base case, if you will.
Yep.
And that's just another reason, right? I mean, it's competition, it's resiliency. I mean, if you look at even markets like Miami, right, for example, I mean, super, super hot during COVID. The issue with a lot of those southern markets, particularly Miami, in my opinion, is like, I mean, they're throwing up buildings left and right on every single lot, right? I mean, at some point you're going to have a supply problem. And the good thing about a market like Boston, I mean, good and bad, is it's impossible to build here, right? I mean, you gotta beg, you gotta get on your knees and pray to God, you're gonna have like a solar eclipse to get building a permit approved here, right? So, it's really, really hard to build here. It means your supply is going to be constrained. So whether you're buying existing product or whether you're the one developing new product, I mean, the chances of getting new competing supply is much lower versus a lot of those other markets too. So that's just another factor.
Yeah, no, that's that's incredibly interesting, man. So I think what's kind of the Flora capital, man. I'm excited to dig into this. I guess actually to kind of transition from literally like what we were just talking to, Flora capital, what's kind of the is that more or less like including, I guess, kind of like the development side as well as kind of like the repositioning, stabilization kind of focus, or is it kind of like, yeah?
Yeah, no, I mean, honestly, this will sound super unsophisticated, but it's just the reality is that was just kind of me branding, just having like a general umbrella branding, if you will.
Yep.
So it really encompasses everything, right? It encompasses the work I do on value add stuff, on dev stuff. I mean, there's no like segments. I mean, at the end of the day, each project is its own separate living, breathing entity with different investors, different structures. Flora was just honestly, like I said, it's not gonna be a sexy answer, but it's really just, it's really like a branding, kind of just having an umbrella. So, when I sign NDAs, I can say what company I'm with.
I hear you, man. I get you. Yeah. I was curious, I was like, damn, like this is pretty awesome.
Yeah. I mean, you've obviously got a solid brand, and, rather than just being my name, I guess people want to see like structure to it. So no, I mean, I'm obviously teasing a little bit, but that's honestly the idea. It was just basically a consolidation of basically everything I'm doing. Just put it under an umbrella so that I have like one centralized umbrella, if you will. So.
Yep. Mm-hmm. I'm trying to think, man. So, what have you kind of seen when it comes to raising capital? And I guess like more or less focused in the current market now. Like, have you seen people that have approached you maybe be kind of like squirmish and maybe a little I can't even find the right word, man, but like hesitant, I guess is kind of the direction, or a lot more people like super bullish on investing passively, like not really able to find much else that can give solid returns and that kind of thing. What have you kind of seen in that department?
Yeah, good question, man. I mean, a couple of thoughts. I mean, I think like a lot of people have probably seen, it's definitely been a lot harder to raise money. No question about it. I mean, again, do I believe the opportunity is here? Like 1,000%. Like, if you can deploy right now properly and you're buying the right stuff at the right cost basis, I mean, you're going to freaking kill it. Right. But the issue is for a lot of LPs out there, and for those folks that are not ingrained in the real estate business, I mean, if I wasn't in the business, I would also kind of be like, hey, like, hold on, pause, like, what the hell's going on here? Is the market, is the sky falling, right? Because if you don't see what's going on, I mean, you're just kind of reading clickbait headlines, right? And I mean, you can see all these headlines of like, again, bigger buildings of what's going on in the South and stuff like that. I mean, there's now, every other day there's a scandal about someone embezzling funds or something like that. So if you're just like a headline reader, I mean, and if that was me, I mean, I would also be paranoid, right? So look, yeah, definitely a lot more questions being asked, and a lot more thoughtfulness needed to be put out there. I mean, I would say generally people are still looking for those kind of risk-adjusted returns, and they still do want them. But again, I think there's more scrutiny. There's more understanding. They're trying to understand better what what their base cases are, what the downside cases are, how bad can it get. Depending on the deal. I mean, if it's a city deal, obviously you're not going to get that much yield off of it. So they want to understand what their upside is. If it's a non-city deal, they probably want to see a little bit more yield behind it, so they feel comfortable deploying. So I think that's kind of conversations I've kind of heard and kind of had myself, right? It's just, people still want returns. I mean, our a lot of our dev stuff that's funded by, like debt structures, if you will, right? So like fixed returns. I mean, people are still hungry to get, good returns on their capital. Again, I would say a lot more scrutiny on the underwriting, and they really want to understand like the numbers and make sure that their downside is protected. But yeah, so there's so that desire is still out there as well.
Yeah, no, I love it, man. I was definitely pretty curious. What's kind of been like a really like I guess kind of like trait, if you will, that has kind of, like propelled you to like the next level and kind of like continuing to roll and that kind of thing. Yeah.
Yeah, man. No, good question. I mean, a lot of it is just really understanding, I would say, the details. Particularly on dev stuff, right? I mean, if you're gonna go into that space, I mean, it is a totally different ballgame, right? I mean, it really is. And that's kind of one of the things I've tried to really get better at over the last 3-4 years, right? I mean, I think 3-4 years ago was the first time we did a ground up project. And I really try to understand better everything from, the zoning and permitting process, what needs to be done, what people think about, the key criteria, to learning to understand better, how to actually logistically work through a site. Yeah, man. I mean, it's really just getting really, really good at the ops, right? Because if you're going to be either developing or even doing heavy value add, people say, what's the common expression, right? Like a lot of people think, oh, your money's made on the buy side. Partially true. I mean, yeah, if you buy a deal at a dumb price, I mean, yeah, you're going to lose money for sure. But I mean, I've seen plenty of people buy good deals and completely butcher them too, right? So it's getting really, really good at ops, right? It's really, especially if you're navigating tricky place to work. I mean, I would consider Boston a very tricky place to work, but anywhere in Mass probably is pretty tough. But yeah, man, I mean, just, like I said, I mean, good people buy good deals all the time and still lose their shirts because they have no idea what they're doing, right? So really getting good at the ops and the details, understanding what you're doing, really getting granular about like, what finished package am I doing on my apartments here versus my apartments there, and if I'm going to do condos or if I'm going to do a single family sellout, what am I doing over here, right? To the details, right? I mean, over the last year, I've had to as I've started to finance more single family devs, I mean, I've had to really get granular, for example, on literally cabinet selection, right? Like something I've never cared about when I was doing purely apartment product, because I would just throw up white shaker everywhere. But now all of a sudden you're trying to sell out a $3 million custom house. You can't really do white shaker, that's not going to fly. So really, yeah. So getting really good at the details of what you're doing, I'd say is probably honestly the biggest thing.
I love that, man. I feel like that's an absolutely huge takeaway right there, man. Was especially something that you mentioned probably like a minute ago about, although a deal may be spectacular, you have to make sure that the people that you're investing with know how to orchestrate that.
Yeah.
And I feel like
times have we seen deals in the South go upside down when we thought they were stealing the deal, right? I mean, it happens all the time.
Exactly. You know, and I think that's something that's definitely, you know, super critical. And there was a guest that I had on a few months ago. She was a woman named Sandia Seshadri, and she's a syndicator down in Dallas Fort Worth. And that was one of the things that she really was extremely you know, knowledge about, is like, you know, just asking a lot of those questions, and more or less on the LP side to the GPs, and like questioning the assumptions, and like, where did you get those kind of numbers? And like, I feel like that's such a big thing, is like, you know, just making sure that like, as an LP, a passive investor, a debt investor, whatever, is asking the proper questions to make sure that that deal that looks freaking phenomenal on paper goes the way that it's supposed to, you know?
Yeah. I mean, absolutely. I mean, on the LP side, 100%. I mean, you know, and I kind of saw it firsthand, right? Like one of my LPs that funded a couple of my, you know, devs for sale the last few years. I pitched, you know, I pitched him a deal that we were doing, that ground up custom home I was mentioning. And he kind of looked at the underwriting, and, you know, he was like, hey man, you know what, this isn't for me, right? Like, this is not the risk profile I want to take on it. And I get it, right? I mean, that's, you know, it's not for everyone, right? I mean, there's definitely a new element of risk in that kind of thing, especially when the market's all over the place. You know, so it's every LP's really got to understand not only the numbers of each deal and what they look like, but also what their tolerance is, right? Like, you know, what am I willing to put my money into? What do I believe can perform over the next 12 to 24 months as we kind of go through this shitstorm, right? I mean, that's important. That's important questions to answer.
Yeah. Yeah, 100%, man. And I mean, even like, you know, to kind of stem back to something that we were mentioning earlier is, I mean, you know, you hear on the podcast and stuff like that, you know, a lot of the those deals from like new sponsors in the past like 3 to 5 years that looked like rock stars until the interest rates tripled. And now it's like, shit, man, like now what, you know? And, you know, kind of navigating that.
Yeah, man. I mean, it's, you know, and this is what you got to be careful about, right? I mean, yeah, I don't, you know, I think it would be, I don't think anyone would have foresaw this in 2018, 2019 when they were putting on, you know, 4 or 5 or 5-year debt or whatever on their properties, right? But I mean, as an LP, right? I mean, these are the things you got to play around with, right? Like, when does the project go south, right? Like, and what's the breaking point, and what's the likelihood of that scenario happening? What happens if that scenario happens? Again, I mean, you know, at the end of the day, it's impossible to mitigate every risk, right? I mean, you know, otherwise you would never be making any money. And, you know, a lot of those guys that bought stuff in 2018, 2019, 2020, I mean, you know, they could still sell out, right? I mean, most of them, if you bought a decent enough deal and didn't overbid, you know, your head off, I mean, you should still have a pretty good cost basis on your stuff, right? So you should still be able to exit. I mean, you're probably not going to get the slam dunk price that you thought you would, but, you know, I mean, if you're buying in those markets that have been blowing up 15, 20% a year and you've been sitting on it for 3-4 years, I mean, you know, you can do the math, and you should be able to exit even if your sales price is 10, 15% below what you thought it would be today, right? So, you know, again, it's impossible to mitigate all the risk, but you yourself gotta figure out, like, what's the risk profile I'm willing to take on. You know, what am I comfortable with? And, you know, because that's how you make your decisions at the end of the day.
Absolutely, man. So what's next, Lior? What's kind of the next thing you're shooting for, man?
Yeah, man. You know, like I said, I mean, I'm looking at a bunch of stuff. I mean, we're looking at you know, we've been buying larger buildings. We're probably going to continue to do that. Looking at larger devs as well. I'd love, you know, we've been underwriting a lot of larger apartment developments. You know, we're currently permitting a bigger one. You know, a little bigger one for myself, at least. You know, it'd be 14 units or something in the city, so it's pretty solid. You know, we've looked at 20 to 40 unit developments. it's still hard to pencil all these numbers out today, between rates and sellers still kind of being tough. But I'd say that's kind of two avenues, right? Is buy quality existing product in markets that we freaking love and that, aren't going anywhere, right? The city, South Boston, South End, we looked at Somerville, Cambridge, right? I mean, these are the markets that I'd roll, if any market's not going to crash, that would be the markets I would choose, right? Where you got, a million little Harvard minions running around. I mean, I probably feel all right.
Yeah.
So yeah, but again, between those two avenues, that's kind of where we're seeing the opportunity, and trying to kind of go into bigger projects, finish and execute the ones that we got going on. A lot of them are going to be wrapping up by spring, early summer, between sellouts and lease outs. And and we'll kind of just see what we can take down.
I love it, man. Super exciting stuff, man. Seriously.
Absolutely. Should be fun. As long as the world doesn't crash, we should be all right here.
I hear you, man. Absolutely. But man. So where on like social media and stuff like that can people find you? I know you got a bunch of stuff, but I'll tag it.
I'm still trying to be pretty active on YouTube. I mean, I gotta say, with all the projects, it's been tougher, but I still try to sling out a couple of videos a week here and there. So you guys can check me on my YouTube, my Instagram. Again, I try to put out stuff as often as I can. Been doing more on TikTok as well. So any of those typical channels, you can figure out a way to connect with me. It's just Lior Rozhansky. So hit me up, and love can help out or answer questions, whatever.
Hell yeah, man. Thank you so much for coming on here, Lior. It was a pleasure to catch up again 3 years later, and I'm excited for the next time.
Yeah, man. We'll have to. I'll put November 2026 on my calendar.
Yeah, legit, right?
Yeah.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs. Get access to our private investor portal and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.